Hello everybody, welcome to the technical analysis webinar here with AvaTrade. My name is Troy, I'll be leading the session. As we get going, if you would, please type OK in the chat box if you're hearing me clearly and seeing your screen all right. All right, great. I've got enough responses. Looks like we're up and running fine. If anyone has any issues as we go along, please feel free to let me know in the chat box. As always, keep in mind, no one trade is guaranteed to bring you profits. There's risk with each and every trade that you take. So in some way, it makes sense that you should manage your risk, maybe stop loss settings, hedge positions, or you could use a unique feature that's available with AvaTrade called AvaProtect, which we'll talk about in a moment. Keep in mind that what we cover is not meant to be financial advisement, but is coming from an educational perspective. Now, we're focusing on technical analysis today. We'll get on the live charts in just a moment to look at some potential trade opportunities. Before we do that, let's just talk real quick. What is technical analysis? Basically, it's looking at the historical movements of the different instruments on the charts and trying to find patterns, repetitive movements, predictable movements based on the history on the chart that might give you some idea as to how the future may go with the movements. And so we understand that the history is no guarantee of the future in terms of patterns and movements, but traders have found that it is very useful to look at these patterns and use them as you go forward in determining strategies and concepts about entry points and exit points to hopefully help your P&L at the end of the day be better. Now, there are a couple different ways to go about using technical analysis. We tend to lean on what we call manual methods of technical analysis. That would be looking at the charts, drawing your own lines of support, resistance, trend lines, finding different ranging patterns, etc., to help you determine where you prefer to get in and out of trades. You also can use indicators that do this work for you a bit, but tend not to be as smart as you can be in terms of understanding the overall picture that's occurring on the markets. And what I mean is an indicator doesn't know what the latest headlines are, what the latest jobs numbers were, etc., to tie in the fundamental news situation, the sentiment situation into the technical analysis. And so usually indicators are looking back a defined time period, going 100% on just the numbers, the statistics within those price movements, and not able to take into account the fundamental situation. Whereas when you're doing your manual technical analysis, you can take into account the fundamental news, and you can have a preferred direction with different instruments while doing your technical analysis. And this tends to work out maybe a little bit better for most traders rather than blindly using indicators that might say buy now or sell now, etc. Now, as we go along, please feel free to type any questions, give any input in the chat box that you might be interested in sharing with others, or questions you might be interested in asking. I'm happy to address them as we go along. Now, this is our web trader platform. We'll take a quick peek at that in a moment. I did want to get an idea of the sentiment as we go into our technical analysis. So it only takes a moment to take a quick peek at the driving headlines for the day to get a feel for the sentiment. And so here's a headline: steel iron ore miners fall as Evergrande approaches crisis point. You might say, well, what the heck does that mean? Who's Evergrande? What crisis point are they talking about? And if you get into the article, you realize that it's a company called China Evergrande, which is a huge deal in China for their real estate development. And so they seem to be selling off their assets. They've been overexposed. They're having all kinds of problems with their liabilities, and this is something where they're looking at possible default of billions, hundreds of billions of dollars. and this could have a cascading effect on the Chinese economy is the fear. And China being the second largest economy in the world, this is a really big deal. And when we look at a headline like that, we can think about the housing crisis that occurred in the U.S. Years back that led to a market crash. And so this is something that's creating a lot of fear out there. We see the volatility index, S&P 500 VIX, it's a volatility index, also referred to as the fear index, is up huge. We're talking over 20%, 21% plus increase on the volatility / fear index. That tells you that indeed there's a lot of fear on the markets right now. And we see the futures, the US 30 is down, that's the Dow Jones, is down over 500 points on the futures. And the US 500 also down big, both down over 1%. The Dow Jones down over 1.5%. That's confirming there is big fear on the markets right now. That is negative sentiment we're looking at. Another headline, why the Fed might welcome a bond market tantrum. This is adding fuel to the fire. The US Fed's talking about cutting back on the bond buying program, talking about maybe even this week. There are Fed meetings on Wednesday this week. Some anticipate maybe they might talk about cutting back on some of the stimulus measures they've been using to prop up the U.S. economy, and so that's creating fear as well. So we've got these two headlines being market drivers, and so those things may come to a head on Wednesday. We see the scheduled announcements here, FOMC economic projections, FOMC statement, Fed interest rate decision, press conference out of the US, all high-level 3-star announcements. That's Wednesday this week on the economic schedule. And so that's a big deal coming up later this week. And we've already got all this fear on the markets. And so we see the sentiment, and as we look at the charts, we'll see gold sold off, some of the major indices have sold off, and you might say, well, why would gold sell off if there's fear? Isn't gold a safe haven? Shouldn't gold go up when there's fear? And we've talked about this in past webinars. It depends what the fear is about. If the fear is about inflation, then yes, gold tends to go up, and that's the safe haven for inflationary fears. But the fear right now is the opposite of inflationary fear. The fear is, wow, the economies could be doing really bad because of a cutback in stimulus in the US, or because of increased virus spread in China, or now because of housing or this real estate giant crisis or developer giant crisis in China. All of those things would be negative economic stimuli, and so that causes the opposite of inflation if the economy suffers and slows down. And so gold is not the safe haven. The US dollar tends to strengthen during those types of economic fears, and so as the US dollar strengthens, gold weakens, down goes gold, right? And that's what has happened these past few trading days, going back into last week. And so the question is, for gold traders, for commodity traders, for equities traders, is this fear going to stick around? Will the inflationary situation come back where, up until just a few weeks ago, it was fear that there was too much inflation and the markets were rising too fast. The economies were coming out of the COVID crisis too quickly with all of the stimulus measures that were there. And now it's the opposite. The opposite is hit. There's fear about economic trouble and maybe stimulus measures being pulled back, creating a perfect storm of fear right now. And so that's the situation we find ourselves in now. To help protect against volatile markets as you're trading to go after these huge potential profits that are created with this kind of volatility, you can protect yourself with a unique tool I mentioned already called AvaProtect. If you use our trading app, which you can find it here, trading platforms, AvaTrade Go, you'll find AvaProtect is available on gold, silver, and most all FX pairings. And so that's one way to protect against losses, is to use AvaProtect. It's for a small premium cost. You protect against any and all losses for defined time periods, by the hour, by the day, etc. Also, what's nice is, regardless of whether you're using AvaProtect on all of the instruments, the order window acts as a trade calculator. So as you're setting up your trade to buy or sell, you'll see that if you program a take profit and a stop loss price, it tells you what your potential profit would be, what your potential loss is to that stop loss price before you ever place your trade. It calculates those things for you. So it helps with the risk management side of things. And you'll see if you use our web trader platform, if you log in from our main website, you'll be in our web trader platform. It trades right on top of the MT4 and MT5 accounts. It also has those unique features in the order window. So if you're trading on an instrument that offers AvaProtect or any instrument, you'll see the features for calculating take profit. You see right next to your take profit price, it calculates your possible profit. Right next to your stop loss price that you enter in, it calculates your possible loss. That's there on every instrument that we offer. And then AvaProtect is available, like I said, on gold, silver, and FX pairings for a small premium cost. It protects by the hour, by the multiple hours, by the day, against any and all losses for those defined time periods, and any profits are yours. So unique ways to manage risk, especially useful during times like now, when the volatility is very, very high, the fear index is going up through the roof. You can go after huge movements of potential profit and cap your risk by using a feature like AvaProtect. Okay, so also you'll see, since this is a technical analysis webinar, I want to show you we have premium services on our web trader platform that offer both fundamental and technical analysis for you. Let's look at the market buzz, or I'm sorry, the analyst views gives you nice technical analysis signals for free. A lot of places you have to pay for signals. These are here free, coming in all day long. It breaks down the direction of the movement, the price levels, the theory behind it, what indicator was used. The comment describes exactly what the analyst was thinking. Very nice technical analysis done for you here. And you can switch between different Forex groups. You can look at cryptocurrencies for those that have that available in most regions around the world. I know UK, some other regions, you don't have cryptocurrencies available, but you've got these other signals as well on the standard currency pairings as well. Now, let's go ahead and jump on the MT4 platform, and we'll take a look at some technical analysis opportunities that are on the market now. I'm on my demo account. You can obviously be on your live accounts looking at opportunities as well, or your demo accounts. Mafana, good question. You asked, why would an instrument be described as a safe haven? And what that term means to traders is many times when there's uncertainty on the market, when there's fear on the market, there are certain instruments that traders tend to buy into as a safe haven asset that tends to retain value even during economic crises. And gold is one of those things, one of those instruments that many times, if there's fear that currencies are losing value, especially if there's too much stimulus being handed out, if there's too much inflation and currency is just losing value, prices are going through the roof, and you know, you need a wheelbarrow full of money to buy a loaf of bread because the currency is losing value. In those types of circumstances, gold tends to retain its value very well. It has intrinsic value for the long haul, and so that's what we refer to as a safe haven asset or instrument. Would be something that traders buy into when they're fearful that other instruments might lose value. And so gold is one of those things. The US dollar also, and along with the Japanese yen, tend to be currencies that are thought of as safe haven, that when there's economic crises, you know, traders tend to rush into certain currencies that they feel are safer, more stable currencies, and the US dollar is one of those. So we tend to see the US dollar strengthen as other currencies weaken during economic crises. Okay, very good question. Now, what we're looking at here now is, what are we on? This is the US Tech 100, so the NASDAQ 100. We see has been dropping. These are the 1 hour candles, has been dropping as expected during all of this fear. Now we see, as we started the webinar, we see what's going on with the sentiment. It's huge, huge fear on the markets. It's hard to say that just because we're at a low point on the NASDAQ right now on the US Tech 100 that you should buy, right? It's hard to buy during that much fear that's on the markets. We see the futures are huge, huge in the red. You know, the NASDAQ has dropped already today. So the question is, what do you do? It's already dropped. Are you going to sell from a low point? Are you going to buy because it's at a low point? And I tend to say that the markets are in your favor when you have two things in your favor. When you're trading in the direction of the sentiment, which right now is down on these major indices, and when you have an entry point that's opportunistic. Right now, we have maybe one of those two things. We have the sentiment on our side if we're selling, but the entry point maybe is not on our side in terms of the technical analysis. And so what we can do then in this type of situation is maybe look to put some opportunistic pending orders that maybe if we get a bounce back up, it might be a spot that you're interested in selling from a higher point here, closer to a resistance level that you think might hold. Now, by all means, if you feel like, nah, I just want to buy on the market, it's a low point, I want to buy, by all means, you can buy. But the point of the strategy that we're looking at right now is to try to align our technical analysis with the current fundamental situation, with the sentiment. And the sentiment being as negative as it is, then what we're looking for is for opportunistic locations to short some of these instruments, such as the US 100. And so if I go to the 4 hour candles, I can say, okay, let me draw a line of support or resistance. And we see right here was an old support level. Support, support, and up. So if we follow that across, we see it broke that support level here with a bunch of momentum. You see the size of this candle, it broke through the support. And then when it tried to come back up, you see that acted as resistance. You see the wick, it came up and then went down further. So if the market could bounce up to this resistance level, that might be a spot that would be an opportunistic location to sell from, assuming that you're looking at the negative sentiment and wanting to short the NASDAQ, the US Tech 100 here. Now, it might not bounce back up there. That's true. But that certainly would be an opportunistic entry point up here at this old support level, which should act as resistance now, barring any major changes in the sentiment today, should act as resistance if the price gets back up there. So that would be a spot where you could think about saying, I could put a pending order to sell if the price bounces back up there. So that's, let's say, 15,240, something like that. So if I switch to pending order, sell limit sells from a higher point. And so an example in this simulation would be 15,240, stop loss somewhere above that, right? Above this old support level. So 15,000, maybe 260, something like that would get above that perceived resistance level to the stop loss. And your take profit could be back near today's low, like where it is now, 15,000, let's say 160. Wouldn't even have to break below today's low to hit that take profit. So we're looking at a stop loss only 20 points away and a take profit 80 points. Okay, so that's what we call an opportunistic entry point. If the market bounces back up near this old support level, which should be a resistance level now according to support and resistance theory. Broken supports become new resistance levels because whatever negative news caused that price level to break still exists. So now it should keep the market from breaking back above that price level. So broken support becomes new resistance. And so if this comes back up, we have our entry point programmed here and our take profit down here with our stop loss above that resistance level. And I could slide this just a little so we can see the lines better. We see there's our stop loss. Here's our take profit. Our entry point is up here. I could delete the line if I wanted to get this out of the way or drag it. Here, let me go to my objects list. I want to get that red line out of the way so you can see the pending order line. There we are. Now we see the entry point, which is just before the resistance level. That's the green line. So if the price comes up to that spot, we're in. And I might drag my stop loss just a little higher to get clear of the resistance level. So the market would have to truly break back above that resistance in order to hit my stop loss, and my take profits about double the potential profit to what I'm risking. Okay, about a 2-to-1 ratio potential profit to risk if it goes up and hits our entry price up there. Yeah, we can take Ursula, we can take a look at the Dow as well. It'll look very similar to the NASDAQ. On occasion, Chris, indices lose some companies and gain new ones. So whether it's the DAX or anything else, they're basing it on the top X number of companies in whatever grouping the industry is based on, whether it's the DAX or the Dow or the NASDAQ. They're taking the top companies, the number of companies that are supposed to be in that indice, and updating them accordingly based on trading volume or whatever their standard is for choosing those companies to be in that indice. And so it happens from time to time. The companies are updated, and it's not always the same 30 companies or the same 100 companies, etc., or the same 500 companies. If we're talking about the S&P 500, that adjusts based on market cap or whatever the standard is that they use to determine which companies are going to be in that indice. So if we use this as an example, the US Tech 100, and then we go and we look at the Dow Jones, we're going to see it's very similar. Here's the US 500. We see there's the plunge. It looks like the same chart as the NASDAQ. Here's the US 30, same chart as the NASDAQ, right? Broken support, breakthrough candle, low point, maybe drawing lines to hope for a bounce back up if you're going to short the market. If you think it's just going to keep dropping, you obviously could short the market from where it is, okay? If we go to one-day candles, we can see there's a little bit of a support level down here that it could keep dropping to. Certainly, if you got in on this hours ago, earlier in the morning today, then you're already way in the money, okay? But these major indices look very, very similar. It'd be the same idea as we just did with the NASDAQ 100 in terms of strategy. Okay, you could wait for a potential bounce to get in on a sell limit if you think the market should drop, but you want a better price to sell from. Now, if we take a look at gold, we see the drop of gold as well, and we're looking at a pending order that I've already activated. And if we look at the last webinar I did last week, we already shorted gold and profited. We shorted a lot of, if we look at the account history, we see we shorted the US Tech 100 that paid out really well in the simulated trade we did. We shorted gold that paid out. I cut it early just for clearing the account out for teaching purposes. I didn't want the trades running, but we see 1, 2, 3, 4 out of 5 trades paid out in the positive. And you see we were shorting the Canadian dollar against the yen. Again, the yen was a safe haven currency. We expected it to strengthen. It strengthened against the Canadian, which we expected to weaken because oil was dropping. So you see, going with the fundamentals with your technical analysis, the type of results you can get. And the one trade that didn't pan out, we said it when we were placing it, that's not the best pairing, because the US dollar and the yen are expected to strengthen when there's fear on the market. And we said these two could strengthen against each other. And so that wasn't the easiest one to pick. It was better to pick something that we thought would weaken, the Canadian dollar, because oil was dropping, against something we thought would strengthen, the yen, as a safe haven. And that's the one that panned out. And so the one loser here, we actually expected to be the weakest trade out of those, and that's exactly what happened. Now, we also placed pending orders last week in case the market went up to a better entry point, and we did market moves. Well, the market moves were the winners, and the market just never came back up because there was that much fear. And the same thing could happen today. We placed a pending order on the NASDAQ saying, well, we'll hope it comes up to a better price. So, if you're wanting to short the market, we could short it from a better price. Well, maybe today it goes back up. And if you're looking to short the market, maybe you can get that better price. Maybe it bounces up until the US market opens today, and then the momentum hits and you get a further plunge. Now you want to use your risk management, because what if the momentum changes? What if a headline hits that the Fed in the US says they're not going to cut stimulus measures yet? Maybe that flips the momentum and everything goes rushing back up. So you better have some sort of risk management. You better have a stop loss at a distance that makes sense to you, or maybe use AvaProtect to manage against risk, or hedge position set up, whatever the case may be. Manage your risk, because as good as things turned out in the last examples I just showed you, the news can change on a dime. So you go with what you know, you trade with what you know, but prepare for the unknown. Have your risk management built in to these moves, because on occasion the news changes before your trades can go into profit. And so you trade with what you know, you prepare for what you don't know with your risk management. So this is the trade that's left over from last week, the pending order that didn't hit yet. But it could. I don't mind leaving this here. This is a old support level right here. Support, support, support on the 1-day candles. It broke the support. Our market moves cashed in, and then now it's trying to bounce back up towards that old support, which should act as resistance unless the news changes. Okay, we're going with what we know, negative sentiment. So, and a strengthening US dollar. So if gold manages to reach this price point, that's a nice spot to sell from, with your stop loss above that resistance, just in case the sentiment changes, right? But as the US market opens, boy, if the current sentiment stays, that puts a lot of pressure on gold to drop, as the US dollar could strengthen. Okay, so if we go to 5-minute candles, you say, wow, look at that climb. On the 1-day candles, we say, no, it's got a ways to go to climb to that resistance. If you go to the 5-minute candles, you say, it's already climbed. So it's all on perspective. Are you a short-term trader or a long-term trader? Are you picky about your entry point or less picky? So if we go somewhere in the middle, 1-hour candles, we say, okay, I see a resistance here on the 1-hour candles, right? We've got that pending order, the entry point's up here. If you were looking to do a market move, then you'd say, okay, maybe a shorter term move is this resistance here. So I could sell on gold and put my stop loss above this resistance. If it breaks that, then maybe it hits my pending order and I sell from this resistance level up here. Okay, just and some ideas, technically speaking. You also could say, you know what? I'll only sell if it gets near this resistance level. So you could put a pending sell limit from this resistance level with a stop loss right up here. And if that one hits and loses, then you've got your backup pending order up a little higher, which is coordinated around this old support level, which should act as resistance. Okay, so you've got two price levels there, a more recent one that could act as resistance, and also an older one up here. Now, what if you're afraid and you say, well, looking at the 15-minute candles, you're thinking maybe it'll just drop now and I'll miss it. Well, then you could sell now, right? So the patient thing to do would be pending order somewhere near this resistance, and backup pending order I've already prepared somewhere up here, and I could adjust that a little, somewhere up here near this old support level, which should act as resistance if nothing changes fundamentally. Okay, so two resistance levels, a closer one and one further away that you could set things up around. So I've already got this pending order set up. I could go ahead and set up one more on this price level area, which would be around 1765, which is pretty close to where gold is right now. So we could either set up as a pending order from 1765-ish, or you could do a market move, right? And just sell now if you believe gold should drop. Again, if you think it should go up, by all means, you can buy. I'm basing this technical analysis strategy around the current sentiment on the market, which is fear, and it's not fear of inflation, it's fear of economic problems right now. So at price 1765 in this example, maybe $10 stop loss, 1775, and take profit could be down near today's low, 1745. Okay, so much better potential profit if it hits this price level here to the take profit, much better potential profit than the risk. About double the potential profit compared to the risk. So we've got two price levels here. If gold pushes up much further, it'll trigger the first sell. If it breaks through, hits the stop loss, then perhaps it triggers our second one just above that stop loss, our second sell position near the next resistance level. Ursula, good question. It's basically what we looked at already. I'm not sure if you were here for the beginning of the webinar, but we were getting a general idea of what's the sentiment. Is there positive sentiment or negative sentiment on the market? And what we mean by that is there fear on the markets, or is there joyous happiness on the market? And sometimes it's really strong in one direction or another, and sometimes it's kind of not so much in either direction. Today's one of those days where it's very strong in one direction. The volatility fear index is way up. The futures market, we can see on the Dow, the U.S. indices, the futures market has already sold off. It looks to be that when the U.S. market opens today, there's going to be a huge surge of fear that could continue. Okay, unless some huge news changes that, that's the sentiment today. Very negative, high fear. Okay, and so once you understand that, then you craft your technical analysis around that current sentiment with entry points and exit points that you like. Okay, so that's the process we've been undergoing here. Now we could take a look at crude oil. What happens to crude oil when there's economic fear? When there's fear that economies could slow down. Right now, there's fear out of China about this developer that has major problems and could have huge implications, negative implications on the Chinese economy. There's fear about the Delta variant spreading and causing economies to have to slow down again. There's fear about the U.S. cutting back on their bond buying program that's been helping the banks and the U.S. economy. All of this fear is fear about things that could slow the economy down. So what happens to demand for oil when economies potentially slow down? Yeah, exactly. Demand tends to drop. And so what are the speculators doing right now? Selling oil because, hey, they expect demand to potentially drop for oil. And so down went oil. Even before the economies have had the problem, oil sold off in anticipation of a potential decrease in demand for oil. You see how that works. So the oil already dropped on the fear that the economy could slow down, even before the economy slows down. So down went oil. And here we see oil dropping down, 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 and reaching a support level right here. Okay. This was old resistance on the 4-hour candles. Resistance. Then it broke through the resistance here and it became support. Up it went. Now down comes oil and it finds support on the old resistance level, current support level. So there's a gray zone right about here at the bottom of these wicks that you say, okay, this is the decision point. It was resistance between these two lines, resistance, and back down, resistance, back down, resistance, back down. It became, when it got above this zone, support and up. Okay, and now it's on that spot and trying to bounce, right? So a purely technical trader would say, I'm buying on this. Would say, I don't care about the fundamentals. I'm just going to buy. I'll take my whatever trade size makes sense for my account and my risk tolerance. I'll put my stop loss below this support level. Now my stop loss is below the support. I put my take profit just before the next resistance. And there we are. I have about an equal risk to reward. My stop loss is below the support. My take profit is before the first resistance level right here. Okay, resistance. And so that's a scalp move. That's a purely technical trade, buying from just above the support level, taking profit before the next resistance, which is right here. Okay, about equal risk reward. Okay, fine. That's a technical move. It's going against the fundamentals right now. The fundamentals say oil should drop with all this fear, economic fear out there, and the strengthening US dollar, which tends to strengthen with fear. All of that means oil should drop, right? But since this is a technical analysis webinar, I'm showing you an example of a purely technical move. Buying from just above the support. It's already bouncing off the support. We see the wick just like it did here. So the technical move is buy and take profit before the next resistance level. The fundamental move, at the same time, I can say, okay, if oil breaks below this support level, then I'm selling. If it breaks the support, I sell, because that means it's confirming the fear. It broke the support level and it likely could drop to the next support level down here. Okay, so at the same time I do a market buy, I can prepare a sell stop. Pending order, sell stop, sells from a lower point. So I can say, okay, at the same time I'm buying, I'm also going to say if the price hits 69.25, if the price hits 69.25, 69.25, then that means it broke the support level and confirms the downtrend. And at that point, then maybe I would put my stop loss back above that broken support, because if it's a true break, it should keep dropping once it breaks the support. So I put my stop loss back above there, which would be at 70 point, and maybe I only want to risk $1 per barrel. Okay, so from 69.25 to 70.25, $1 per barrel risk. My take profit could be down here before the next support at 68 even. Okay, so I'm going after potential profit of $1.25 per barrel from 69.25 down to 68, and I'm risking $1 per barrel. And I might say, you know what, I don't want to risk a full dollar. I only need to risk to 70 even. So now I'm risking 75 cents per barrel and going after $1.25 profit per barrel. That's up to each individual trader, how far away you think you need your stop loss, right? The entry price is here at 69.25. My stop loss is up here. And I might say, you know what? I'll slide my entry price up a little because it broke the support. Even if it hit 60.5, it broke the support. So maybe I get in a little sooner. And that means my take profit can make more profit. I can slide that down and still be above the support level. Okay, now I'm about 2-to-1 ratio, right? Potential profit to risk. And it's nice, the MT4 platform, once you have your pending orders, you can adjust them a little as you look at your price levels. Your resistance level, we've got our entry point just below, which what would be a broken support and would become resistance. We've got our stop loss up here, clearly above what would be that broken support. So it's clear of the entry point and back above that price level. It would take a true reversal to hit our stop loss if the sell stop is triggered. And our take profit is just before the support level down there. So we've surrounded this oil movement. We're either going to make profit on the climb here, or we're going to trigger potentially a sell stop and go after a profit on a potential further drop. Any questions so far? I've been talking a lot, I know. Any questions beyond what was already typed? Okay, great. Well, listen, everybody. I think this is a good place to stop. We've covered some commodities, some equities, the indices here. We've looked at gold and oil. Look on U.S. pairings for the USD to be bullish. Okay, potentially. So if you're looking at Euro USD, GBP USD, etc., Australian USD. Especially because the Australian dollar tends to do badly when China does badly. So if you're looking at currency pairings, Australian USD could be a nice pairing to look at because the Australian dollar should be very weak with bad news out of China, and the US dollar should be very strong with fear on the market. So to find a high point on Australian USD to potentially short it, you could follow the same sort of strategy we just did with oil and with the NASDAQ, with gold, etc. Okay, Australian USD. There's a question about wheat. We traded an example. We simulated a trade on wheat in the last webinar you see here, and we shorted it. Why did we short it? Number one, because it was right below a resistance level. So technically speaking, it was a nice short, a nice sell. Because it was at a high point just below a resistance level. And also we figured with the US dollar strengthening, with all the fear, that would help pull wheat down, which is what happened from last week into this week. So the same strategy could hold true for wheat, really any commodity. If we're expecting the USD to strengthen, if there's economic fear, that tends to weaken the commodities. Even the soft commodities, and a bullish USD helps to pull those down if indeed the USD continues to strengthen. So I would look at those potential opportunities with wheat and pretty much all of the commodities if you feel the fear will continue and if you feel the USD could continue to be bullish. Okay. All right, everybody. Thank you for joining. It's been a pleasure. Good luck with your trading. Definitely make sure you manage your risk as the U.S. market opens today. There is huge volatility expected. That brings huge potential profits. Just set up your trades accordingly to go after the potential profits in the direction you expect the movement to go, and back yourself up with proper risk management. So you have a measured risk going after a nice potential profit. All right, everybody. Bye for now. Good luck with the trading. And till next time, I wish you great profits.